Welcome back to another case study. This was November 9th, 2021. It's on NQ and ES, and I'm developing student. These are just my interpretation of the price, and shout out to ICT. So if we look at the daily chart on NASDAQ, what is order flow overall? Order flow overall is bullish, but if we look at the previous 2 days, we've had a indecisive candle or doji candle, and then we had another kind of indecisive day. So therefore, this could be priming us up for a possible potential reversal in the market, or not reversal, but full on just looking to possibly see maybe this fair value gap, this fair value gap, or this fair value gap to get rebalanced to it. If we see today, that's kind of exactly what we had today. And if we zoom down to the lower time frames, it becomes a lot more obvious and a lot more clear on what happened and how you could have traded this. So right now, I'm just gonna pull up a chart of DXY. Just give some reference just because we're at all-time highs. So we look at DXY, we just took a buy-side liquidity pool, and then we have come back down to this 4-hour fair value gap. So if this is the 4-hour chart and this is the 1-hour chart. So we look at DXY, we come back down to this this fair value gap, and then we're possibly changing our state of delivery right here, and then we're looking to maybe see if we could rebalance this area here, which looks like we did before 9:30, but this is 9:30. We come back up, and then we make a new attempt on new highs. But so, like, in this instance, I'm not going to really, like, have a overall bias just because of DXY, but it's just something to kind of add, just have a little bit confluence. So we see, since DXY has hit an area of resistance, a fair value gap, we could possibly see some upside, which could indicate lower prices on indices. So right off the bat, this is NQ on the left and then the Dow on the right. And I just want, if you want to write your annotations right now, do so, because you're going to get the most out of it. And here are my annotations. Right here, we have the 1-hour fair value gap. We're coming back within. We take buy-side liquidity, and we can see here that we have an SMT forming at these highs between the Dow and NQ. So that's kind of your context, SMT at highs. And if you look here on literally both of them, we have high resistance liquidity at the highs, and we have low resistance liquidity at the lows. What is the market likely going to favor? Low resistance liquidity. Simple. And here's the NQ chart. If we zoom out, you have a 1, 2, 3 drive, high resistance liquidity. We continue to make new highs, and this right here, this indecision here, and then the breakdown market structure shift. This leads to us having this bearish bias today. So the fact that we have made a 1-hour fair value gap, and look at where the market's trading to right at market open, right into that fair value gap, that tells us that we really want to see lower prices. This is just a fake move, and we're likely to see lower prices. We have high resistance liquidity up here and low resistance liquidity down here. If we were to flip a coin, or if we were to have, in terms of probability, what is the market going to favor? Low resistance liquidity over high resistance liquidity every day of the week. And here is the 15-minute chart. As we see, overnight session is falsely leading price. This is a classic Judas swing profile. Look at what the overnight session is doing. Continue to chop higher, or continue to reprice higher, or reprice higher, or reprice higher, up into this key level, this higher time key level. After we've had market structure shift on the daily, we come back into that imbalance while forming SMT above midnight opening price and above 8:30 opening price, and then that's when we really break down and have this huge displacement. Like, this huge displacement doesn't come out of nowhere. It comes because all these factors are coming together, and everything is coming together. That's how you get your bias. That's how you're going to get your best trades. And then this is a 5-minute chart. I feel like I should have had like slides without annotations and then annotations, because you're watching this, then you really get more out of this video. I'll probably do that in the next one. But basically, right here is market open, and 8:30 opening price. You draw that out in your chart, and look at this. Right here, we have all of this leading us into our high time PD rate when we're bearish. This is exactly what we want to see. This is exactly what you want to see. Like, if I could say, like, if I could grade this on like an A to A plus setup, I would say that this right here is an A plus model, the Judas swing model. So right here, you draw that 8:30 opening price out in the future, because we are well above this 12 a.m. opening price. We're gonna manipulate above this, taking liquidity in that higher time PD rate and forming an SMT at a certain time of the day. Notice how this doesn't happen other than 9:30 a.m. because that's when the market volatility happens. That's when the liquidity injection happens at market open. We come up, we push up, take this high here, and then it's just all selling free. And if we look at here, I marked this as a BPR, and this is just because we have this big wick here, and this is a stop hunt. So the fact that this is a stop hunt, this is an event in price, and therefore This isn't like a true wick. This is a manipulation wick. So I'm not really going to mark that out. And now what does this become? This now becomes a fair value gap. And now this is a balanced price range. And notice the sensitivity around that. And you also have this order block right here that we tap the wick of, and then we sell off. We reprice lower. And then this is the 1 minute chart on NASDAQ, which I honestly didn't think was the cleanest. I think the ES had cleaner action. But if you look at this, look at how much time they're giving smart money to initiate shorts. Look at all these wicks. We're staying within this area, and then at 9:47, around that 9:50 time, we end up getting that displacement lower to all this low resistance liquidity. So we look at this fractal here. We've already had the market structure shift. This now becomes your breaker. You have your low, high, lower, low, or sorry, this now becomes your breaker. I didn't annotate that, but this becomes, the lowest down close candle. This would be your breaker. Draw that on time. Where are we at in time? Where are we at with all this? We're still respecting that breaker. We're still respecting this breaker right here, and then we end up selling off. Boom, right at a certain time. And I want to draw attention to this as well. We have this. I marked this out because this is just like old fair value gaps that we draw out in time. And then look, you have a overlapping imbalance, institutional order flow entry drill, because we have these overlapping imbalances. Price doesn't need to go all the way up to here. That's why we continue to sell off. And then this is that 950 macro, just zooming out a little bit into the draw liquidity, which was that 1 hour fair value gap. Like if we go back to this chart, which I kind of forgot to point out, we're taking liquidity here, and then where are we going? We're rebalancing to this imbalance here that needs to get rebalanced. Like, I think that this is like as clear as it gets. This is as clear as it gets. And then this is ES. Is ES at the same time this is happening. 9:30 manipulation above 8:30, manipulation above midnight opening price. Sorry, this would be your 8:30 opening price. We manipulate above that, and this, you can see the entries are a little bit cleaner. We end up getting market structure shift. You have a breaker right here paired with that fair value gap. That becomes your unicorn setup right there. Boom. And then also look at this wick. Notice this wick right here. The fact that we have this wick here, and then we deliver a fair value gap here, and we come back up. That's why this ends up going. We don't need to go higher. And then we also have that breaker. And then we displace lower. We create an order block right here, and look at the delivery price right there. Look at the delivery price. If we look at this whole fractal on price, there are a lot of wicks. There's a lot of wicks within this range. So just something to note. There's a lot of wicks within this range. Come back up, order block, boom, displacement. We don't revisit this area. We have a fair value gap here, boom. And then with this is an implied fair value gap, which we're going to zoom into the next slide. And we end up just displacing lower, fair value gap, paired with the old low. It now becomes a PD array. Boom. So this is an implied fair value gap. You have this encroachment of this wick, and then you have encroachment of this wick. And look at the delivery. Perfect delivery to that wick high. Or I guess like barely off, but pretty much essentially to that encroachment of that wick. And then the price tears it lower. And also what I want to point out is if we take standard deviation from this swing high to this swing low as a fulcrum point, where do we where does price randomly stop here? Right at negative 1.5. Right at negative 1.5. All right, and now if we're looking at price from now on, this is the 15-minute time frame. I don't know if I have a 1 minute chart pulling up here, but basically after prices deliver the draw liquidity, hands off. I'm just gonna wait to see what price does. As we see, we end up getting an IRL to ERL trade setup that ends up being very good trade. Like there was some opportunity without this day. That's why I'm going over it. And if we see here, we failed to reach consequent encroachment of this fair value gap right here, and the price ends up breaking down and then coming back to this sell side liquidity here. We have IRL to ERL trade setup. Let's see how we could have got involved with that right here. We come back up into this fair value gap, and we look at these wicks here. These two wicks here. This is balanced. We have sell side, and then we have buy side. We're expecting this to be left as breakaway because it pairs up with old selling. So price doesn't need to return all the way up here because all of this area up here is a balanced price range. So if we actually are bearish, this is where we should see some resistance, and that's exactly what ends up happening. We kind of overshoot the fair value gap just a little bit up into that balanced price range. We end up having a big beefy up close candle here, followed by displacement lower, and that changes state delivery. As soon as we close below this price, this now becomes your order block. Draw that out in time, and as you can see, boom, that's right where we end up, like to the tick. Bodies are perfectly respecting that. That's very nice delivery right there. Boom. So let's zoom into the 1 minute chart here. Sorry, it's a little bit messy, but as you can see here, we have high resistance liquidity conditions to the upside. And like I was saying, do you really want to be trading this? Like, there could possibly be something that you could pull out of this to look to rebalance, but it's just choppy. It's just choppy. It's just choppy. It's just choppy. High resistance, high resistance, high resistance. We want to be in those low resistance liquidity conditions. As you see here, we come back up, fair value gap. That might be a little bit too early. You might want to see a 5 minute change of state delivery. 5 minute change of state delivery happens here. This is that 1050 macro. We end up coming up, and then we have this fair value gap right here within that macro. And here's a great idea. Here's a great example. Sorry, not idea. But the fact that we have this fair value gap, we end up immediately selling off, and we don't take the draw on liquidity here. As long as you're taking partials, you're getting paid. So the goal is not to. We don't need this terminus to be profitable. Say you took a trade here, you have a runner here, and then you put your stop to break even. Okay, you got stopped out perfectly. You got stopped out. Okay, it is what it is. It's part of the game. It's gonna happen. So say you took this trade thinking that we were gonna sell off. We did. Take partials, and then we end up holding this rejection block here. And we come back up. We accumulate more liquidity here. Low resistance liquidity signatures. Then we have high resistance liquidity signatures. We end up forming an SMT right here with YM, I believe, at a certain time of the day. This is that 1050 macro right here. We come up, displacement, boom. This candle right here is 1150. I didn't mark it out because I want to show this candle, but we have 1150 right here. That macro, boom, big displacement. This is what you want to see. And notice I didn't have this marked out as well, but if you were to swing grade this, you would have that stop hunt around 50%. We have a stop hunt, and that's what completes this model. We have a stop hunt. We never really have a stop hunt here, and now we have a stop hunt. Boom. And I also wanted to point out standard deviation. What is this? Soups. What does this line up with? Right here. That's where we put that low in at. We have this standard deviation from the last manipulation move, and we also have this retracement leg here as well. They both mark up extra confluence that we could possibly see a possible reversal here. And now, this is the last fractal price. This is kind of the end of the day. This is that silver bullet hour. I would personally probably say if I was active within this, I would have been looking to probably step away. But we know that there's still going to be opportunity, and we can just dissect it, we can study it, and we can just put it in our journals. So as we can see, we have delivered enough. Like, we have gotten enough out of this. If you took a trade here, just sit back and just look at what price does. You don't need to be engaged because, one, it goes against the overall theme of what price is currently doing right now. We are shifting gears, and if we look at the hourly chart, we're right now on the hourly chart, we're bearish. So for me, I wouldn't really love this, but the same concepts are there. So we have constant encroachment of this wick, map that out. We end up respecting it perfectly. Look at the wicks, look at the wicks. The bodies are showing the narrative. We have an SMT that forms at these lows, confirming that we probably don't want to go lower. We now have high resistance liquidity, and we now have low resistance liquidity signatures above us. Right here on the 5 minute, as soon as price closes above this last down close candle, that now becomes your order block, changes to delivery, whatever you want to call it. Price comes back down, median threshold gets respected. Then we have displacement higher. Then we create a fair value gap. We also put in 3 equal lows here. We barely purge buy side here, and then we come back down to get a purge on this, to then come back up to have a more meaningful purge on buy side here. So this is a double purge, I believe. I don't really use double purge that much, so like, I'm sorry. But basically, this is just an example of double purge. You have a very shallow range of liquidity here. We know that price is probably going to more meaningfully take these stops. So we end up coming have a double purge right within that fair value gap with these equal lows. to have displacement higher. And this is that 1 minute chart here. And as you see here, this delivery down here, there's a lot of wicks within here. So I don't know. I'm just gonna back this. I'm just gonna have this in my log, which is why that's why I'm saying like these are just my interpretations of price. This wick and then this wick, constant approach for those, that makes a fair value gap, which I don't know the validity of that. But you also have a breaker here. This now becomes your breaker, the last up close candle before the right on sell stops. So I would more attribute this to that breaker right here, but we also have these wicks here that offered maybe a potential fair value gap. We've had market structure shift, pull back down to that area. Oops. And then we end up having displacement higher. And what time is this occurring at? That's crucial. What time? What time? 2 p.m. This would not happen any other than 2 p.m. And maybe you're looking for a real fair value gap to get engaged with for that silver bullet hour. All right. We have displacement higher, and then we pull it back. Boom. First fair value gap. I didn't map this out. This is probably in a equilibrium maybe of this range. If it's not, it's probably within equilibrium from the change in state delivery of this range. We come back down to that fair value gap. That now becomes your silver bullet. So then we have come up to take that buy side liquidity. And notice this as well. This is a breaker or mitigation. I would label this as mitigation. But right here, look at this high right here. This is when old lows become support. This is when old highs become support. Boom. So in this case, this would be a strong retail support level right here. But why is that happening? Because we've rated sell stops, we've had SMT. This now becomes a mitigation block because we know that old selling occurred within here. Old selling now becomes new buying. And boom, we come up right to that fractal up here. Oops. Hey, wait, hold on. What's happening? Yeah, and then this is just what ends up getting delivered throughout the rest of the day. We end up having a market maker buy model throughout this rest of the day. So if we look at what price did today, this was a very nice day. There was lots of opportunity. There was lots of areas to get engaged. There was lots of areas to get involved. Every time that I look at it, and you have 3 different like fractals of price where you can dissect a trade off of, which is this first initial 9:30 a.m. trade, and then you have like a lunch trade or whatever before lunch, and then you have the last set of like a last good setup with good framework. That is a very good day with lots of opportunity. When you have 3 possible like good trades that you can dissect from, that's more than enough. And even what I'm doing is like I'm more focusing on like the 10 a.m. Displacement. That's what I like. That's what I'm drawing towards. So maybe you just need that 10 a.m. window. But maybe you like that lunch macro. Maybe you like this market maker model right here. Maybe you like this market maker model right here. It's all up to you. And now we turn that into this right here. As you can see, everything kind of played out. We had very nice delivery, and actually I forgot, I never really put in standard deviation projections from this right here, from this to here, but they might line up. You might be able to do that within your own study, but anyways, this is just my case study on this data price, and we'll be back at it tomorrow. I will be doing these every single day. Like, there will be a case study for me every single day, and we'll be continuing doing these. And it's gonna be cool as well to see like how my interpretation of price like increases as I do these over time. So anyway, I appreciate you guys, and I will see you guys in the next one tomorrow.